Hello, everybody, and welcome to this update on FIGS and more specifically their Q1 2023 earnings. So, what is FIGS? Well, if you don't know, FIGS is a lifestyle brand, also called a neobrand, and it's a lifestyle / neo brand for a new generation. And really, these brands are mega trends. Why are they mega trends? Because they're riding the tailwind of old, dying brands. You know, the question is like, what does a brand like The Gap or like The Limited mean to a millennial or Gen Z consumer? Probably not as much as, say, an older consumer. And they're taking advantage of lifestyle brands. They're taking advantage of the end of the malls. They're taking advantage of the lack of prominence of television to introduce a new brand and grab market share. And what is FIGS doing that in? What is the style of FIGS, right? Because brands are less and less generalist and more specialized. FIGS style is the scrubs and the scrub business model. So what you can see is that the scrub have really never been disrupted. You know, most hospitals have scrubs that look like this, that are overly baggy, no fit, no fashion, nothing at all, just a walk tool. And they're going from this to this, and they're trying to turn the scrub into a fashionable statement piece type of clothing. And that is one of the actual playbooks that you find in clothing. They are taking the uniform of a group and transferring it into a widespread fashion, a fashion for everybody. This is a playbook, by the way, in fashion that has been used for centuries. When you do research, you note quickly that military clothing that used to be worn by kings, even clergy clothing, they've all influenced popular styles later on. Styles of clothing build on uniform trends or uniform groups, and they aspire to the values that are shown by these different groups. The playbook of FIGS is that of Lululemon. You may have heard of Lululemon. It's an extremely successful company. In fact, the returns that they've had are just outstanding for the retail sector. They've had, I don't know if you can see on the side, they've had almost 26% CAGR for 13 years. In this sector, in the retail clothing sector, it's absolutely outstanding. If you compare to Kohl's, Kohl's has been nothing but flat, which of course in real terms is a catastrophe, a tremendous decline with inflation, and that's because of these new brands. But what is the playbook of Lululemon, right? The playbook of Lululemon is step one: you take the traditional apparel of clothing of a group that could make a brand, and an inspirational group. In the case of Lululemon, it was in the late 90s. Got started in the late 90s. They took yoga enthusiasts as the group, yoga goers, people walking out doing yoga. Then you take that and you change the clothing. You make it better fit. You make it fashionable. You promote it as daily wear. And then the step number 3, once you've done that, you succeed. You succeed. Why? Because you've just offered a radically different clothing with a radically different appeal to the consumer, radically different values related to that group. And so what Lululemon did to yoga enthusiasts and taking yoga wear into everyday wear, FIGS is trying to do the same thing. We're using that same playbook, taking scrubs, which I'm going to call this, for the sake of video, I'm going to call it scrubs is the apparel of healthcare enthusiasts, or at least people who work in healthcare and who love their job and who love healthcare. And so it's taking all of these values, and of course, these values are present in society in many ways. First of all, healthcare is a rather flattering field, right? It's a profession that a lot of people aspire to, and you have a lot of popular culture around healthcare, right? All of these shows. How many shows do we have in healthcare? There's probably as many healthcare shows as there are, say, police shows. So you're taking the appeal of this group, and you're taking the clothing of this group, which is the scrub, and you're turning this scrub into something that is a better fit, that has better fashion, and you promote it to everybody as daily wear. And if you live in the US, like I'm not a nurse, I don't work in the medical field at all. I've received ads in the mail, an ad in the mail for FIGS. and there's nothing related to me with nursing. So that's what I mean by saying they're trying to make it daily wear and to promote it for everyday wear and everything. And let's get into the quarter now. So in the quarter, let's talk about product innovation. So they start their investor slides, and they show this beautiful thing, which is the layering system. This is the FIGS product innovation. You can see they're moving away from scrubs. They're using scrubs as an excuse to enter a broad clothing market, and I think you will all agree when you look at this that few of this clothing, if any, really look like scrubs. The only sign that these are scrubs are the stethoscope, or is it a stigmothermometer? I don't know. It's the heartbeat thing here. That's the only thing. That's the only thing that signals that they're healthcare workers, right? Nothing else. If you were to remove that heartbeat piece of equipment, if you were to remove that, you wouldn't know. You wouldn't be able to tell. And that is the trick. That is the magic of neo brands. They're really carving a niche for themselves in that marketplace. And I think from a strategic standpoint, FIGS is really right on. And let me show you how right on they are. So I took some clothing here which I found to be the least related to nursing, and I went on Lululemon's website and try to look at the same type of clothing and see what I could find. And by the way, I did not search a long time. Like you would think I digged in there. I didn't dig in there. No. These are front page styles on Lululemon. So this is FIGS. So this guy, of course, FIGS. Woman right here, she is wearing a FIGS apparel. They are both wearing FIGS. And this is Lululemon. This is Lululemon's men's fashion, and this is Lululemon's women's fashion. Look at this. I mean, could you make this any closer? So that's why I say fashion often rhymes, doesn't it? Right? It really does. Could you make it this any closer? Even the way the models look, it's striking. These two men right here, they look alike. And they look alike here too. Look at the hair. Look at the way the hair is done. Isn't that interesting? That's absolutely fascinating to me. So to the question, is FIGS Lululemonizing itself? Yes, FIGS is definitely Lululemonizing itself, and I consider this to be a good thing. It's definitely a good thing. I don't know how I'd call this, Lululemonification. I consider this to be a good thing because look at the compound average annual growth rate of Lululemon. Absolutely outstanding. I am glad that they're taking this playbook. So that's wonderful. And then another good thing of the Q1 that I see is that their international revenues are way up 45%, and that is also Lululemon's playbook. If you follow Lululemon, they're very big on China right now, and trying to go into the Chinese market. So that's the good of the Q1, and that pretty much stops here. I'm sorry to say it pretty much stops here because there's definitely a growth slowdown, and it's still in effect. Albeit it's not as bad as we feared in when Q4 2022 was reported, but it's still pretty bad. The Q1 revenues are only a 9% year-over-year increase. Right, sad face here. It's not very good. However, what's decent is customers. Customers grew 22%. So that means that they are making strategic progress. Like they're gaining new cohorts of customers at a much faster pace. But obviously the average order is down by single digits, and what that leads to is an average order down. The average basket is down, and so even though they're gaining customers, these customers order less and less, and that has to do with the economy, right? The healthcare sector is currently cooling off, right? Healthcare was a sector that was doing very well in 2020, 2021. Right now, you have a cool off in the healthcare system, and I can easily make that link in my mind. That's very, very, very clear why the sales would be down in healthcare. you know, in my channel, I like to dig on quarter over quarter to make sure there's no issue with the business. So I did that too, because they did report a 17% sequential decline between Q4 and Q1. But this is not a worry, because this is a highly seasonal business. Q4 is a huge quarter for them. Q1 is historically a horrible quarter for them. And actually, late 2021, early 2022, when FIGS was still booming, they dropped their sales by minus 15%. So really a 2% difference here, not meaningful. It's generally in line in my view. But overall, there is a slowdown in revenue. Now, what's good is that the gross margin remains absolutely unchanged at 71%. And that is a big draw for me to look at this business. Major draw for me, because if you think about it, 71%, that's a software-like margin. That's a really, really good margin on clothes. It's like, I don't know if that many people know clothes are that profitable, but it's a profitable business at 71% gross margin. You're getting high software margins here. The guidance, what about the guidance? The guidance was slightly improved, but it's just the range that was improved. It's not very good. 5.5 to 7.5%. You're barely above the rate of growth of the economy, which is what the most mature businesses usually show. And they are having what I'm calling cash flow, because I'm using adjusted EBITDA as a cash flow, but they're having a quasi cash flow yield of 13 to 12%. Yeah, I'm gonna call it 12% based on their guidance. So 12 to 13% cash flow yield, and this leads me to this fair question: is FIGS looking too much like a value stock for me right now, and for the stocks I cover? Because this looks like they're headed in the direction of the value stock. But of course, that doesn't do it, because I'm seeking to beat monetary inflation, and I consider that real returns really start after the company takes in 15% more dollars each year, because that's historically that's the rate at which the money stock has grown historically. And so you gotta keep up with the money stock increase, and you have to gain as many dollars as the money stock gains dollars. Otherwise, you're falling behind. And to me, even though this may look fine for a value investor, for a growth investor, and a growth investor is someone who seeks to achieve higher returns, for a growth investor, this is insufficient. And so that's why I'm really wanting growth to return. So FIGS appears to be optimizing for earnings, right? They're choosing to generate actual profits, and they could actually make the choice to increase marketing and innovation spend. So one of the questions that I have is, would we be better off if a company like FIGS took some of that money that they're having in earnings and they're having to pay in taxes, the $2.5 million that they set aside this quarter for taxes? Would it be better spent earlier in the balance sheet, in the operating expense, and spent on things like marketing or new product development? Because when you look at this, that product development seems mostly like inspiration to me, right? It's very similar. It seems, it's not very costly. It seems like you're inspiring yourself more than really doing some true innovation. I may be a little unfair here. You want to be frugal when you innovate, but if not innovation, then maybe marketing. Maybe you're not doing enough marketing. You're not doing enough awareness. Maybe you're not doing good sales on your website. Maybe there's like an easy sell that you could make on your website to increase the sales. But I would frankly, as long as they're free cash flow positive. So since they're free cash flow positive, I would rather have them show negative GAAP earnings. It's just that the market is so short term right now that they have a lot of pressure to have positive earnings. Now, there is a few other good things, and I will finish with this that I think is good for a business, is that they're trying to create this Teams business where they would sell directly in bulk to hospitals, dental offices, etc., etc. So I think that's a nice investment, and they're investing in infrastructure to essentially increase their gross margin, and that's also pretty good. But the moral of the story is this stock is not growing very fast, despite, I think, the very strong strategic fit. I think this stock is in line with the time. It's at the heart of a mega trend. I think it has a lot going for it from a strategic standpoint, but it's not showing up in the finances right now. And I think a lot of it has to do with healthcare cooling off. and we'll see. I look forward to seeing over the next quarter what it does. But to me, my advice to this stock would be spend a little more on marketing, please. Spend a little more on innovation. Try. I think it's too early for this company to show earnings, and they're clearly having a recycling of their shareholders. If they're going to be operated like that, they're going to have a lot more value-oriented investors and a lot less growth-oriented investors. But that is just my view. I continue to follow the stock, and I have a teeny tiny position. I'm not adding to it as long as I don't see meaningful change to the upside in their growth numbers. So this was it for this video. This is not investment advice. This is just entertainment. I hope you were entertained. I appreciate all of your likes, all of your subscribes. Have a wonderful day.